Softlogic Life's latest performance presents a real puzzle. You see, on one hand, the headline numbers tell one story, but if you dig just a little deeper, the reality of the business is something else entirely. So check this out. The company reports a 20% drop in net profit. And, on the surface, that sounds pretty concerning. But here's the twist. At the exact same time, its core insurance profit, the actual business of selling insurance, surged by nearly 60%. So what is really going on here?
Okay, quick heads up. This is fundamental analysis for educational purposes only. It is not financial advice.
All right, first up, let's deconstruct their profit engine. We've got to separate what the core business is doing from all that market volatility.
And this table, well, this is where we find the smoking gun. You see, the entire profit drop, every bit of it, comes from a massive 66% collapse in net realized gains. Now, these are volatile one-time profits from investments. They're not the main event. Meanwhile, look at that second row. The core underwriting profit, it absolutely soared by 59%, jumping from 2 billion all the way to over 3.2 billion rupees, a huge difference.
So when we talk about the health of that core business, there's really one key metric we need to look at. It's called the combined ratio.
And for Softlogic Life, that combined ratio came in at 90.2%. Now, that might just sound like a number, but that is a massive improvement of 6.7 percentage points from last year. That's a big deal.
So what does that actually mean? Well, think of it this way. For every 100 rupees the company brought in from premiums, it only had to spend 90.2 rupees on claims and all its other expenses. Anytime that ratio is below 100%, it means the core insurance operation is making a profit all on its own before it even earns a single rupee from investments. So how'd they pull that off? Was it just luck with fewer claims? Well, if you look on the left, their loss ratio, that's the money they paid out, it held pretty steady. The real story, the driver of this whole improvement, is on the right. Their expense ratio dropped, and not just by a little, but dramatically. This is a textbook example of operating leverage, where your revenues are just growing way, way faster than your costs. Okay, section 2. Let's follow the real cash. Because, accounting profit can sometimes be, misleading. If you want to find the ground truth, you've got to follow the actual cash. Which, of course, brings us to the most important question any analyst can ask. How much of this accounting profit is actual, tangible cash? The answer is pretty stunning. 280%. That's the company's cash conversion ratio. Let me say that again. For every single rupee of accounting profit they reported, the business actually generated 2.8 rupees in cold, hard cash from its operations. That is an incredibly powerful signal of high-quality earnings.
And this chart just lays it all out, plain and simple. That bar on the left, that's the reported net profit, 2.29 billion rupees. But the bar on the right, that's the 6.42 billion in cash the company actually generated. So the headline number wasn't just a little misleading, it was completely masking what is essentially a cash-generating machine. So you might be asking, what did they do with all that cash? Well, with over 6.4 billion rupees in operating cash flow, they went out and made a strategic acquisition, they plowed over 2 billion back into investments, and they still had enough left to return over 1.4 billion to shareholders in dividends. Pretty impressive. All right, next section, we're talking about building a stronger foundation. Because this kind of powerful cash generation, it doesn't just vanish. It gets put to work, building a stronger financial foundation for the future. And we can see that impact directly on the company's balance sheet. And yeah, the results are crystal clear. Total assets are up by almost 29%. The investment portfolio, that's up by over 31%. And the net asset value saw a healthy 12% increase. So in short, all that cash from their operations is being reinvested to build a bigger, more valuable company. Okay, so let's step back for a second. This whole analysis gives us 3 really powerful lessons that you can apply when you're looking at any business, not just this one. So here's your analyst checklist. Number 1, cash flow doesn't lie. Always, always check the accounting profits against the actual cash generation. Number 2, especially for insurers, the combined ratio is king. It tells you everything about the core operational excellence. And finally, number 3, treat investment gains like a bonus, not the main business. You have to focus on the core business model. And that really brings us to the crucial point here. You always have to focus on the recurring core earnings of a business, not the volatile one-off windfalls, because that is where you'll always find the real story hiding behind the numbers.